In this video, I'm going to talk about something that I feel like the average Wall Street Bets degenerate doesn't have. Risk management. So if you're a Wall Street Bets member, let me quickly explain why your entire stock portfolio crashed lower than the literal 7 levels of hell. Risk management is the process of taking a proportional risk in a trade. Basically, you don't YOLO your entire portfolio in one trade, specifically a 0 DTE option. Let's break this down even further because I still don't believe the Wall Street Bets people can understand me yet. If your Robinhood account has only $100, you should only invest $10 to $20 in one position or trade. Some people could argue up to 30% of their portfolio at any given time. In my opinion, how much you risk honestly depends on the amount of alcohol in your system. The more you risk, the tighter the rope around your neck. Moving on, risk management is a tool that is utilized by most traders. The expression live to trade another day is something that should be taken to heart. The market is quick to humble you. If you play with fire, you will inevitably get burned. A form of risk management is a stop loss. For example, if your stock or option lost you more than 15 or 50% or whatever you can emotionally handle, your brokerage will immediately trigger a sell to prevent you losing more money. This helps when you cannot be looking at your cell phone all day and the stock decides to crash. Another form is just to avoid options or stocks that simply cost too much money to own. Example, if I want to buy an option for $200 but my risk tolerance only allows me $150, I should not buy or even be looking at the $200 option. It's simply not in my range. Even if I'm overly confident the trade will go in my favor, I should still stick to my risk tolerance and not go outside. The final form of risk management is a lot of booze. There's a reason most stock traders have an alcohol addiction. So now you know what your risk tolerance is that does not completely fuck your portfolio. Let's say you start making money and start losing less. When should you decide to take more of a risk? I get this question a lot and I usually tell people they should accept more risk once they have doubled their money and they can make gains consistently longer than 2 weeks. I only say this because you can trade with mostly profits and less of your initial investment. If you lose, oh well, it's only profits and not hard-earned cash. Now I'm going to say something that's definitely going to piss off some of the stock community. I like trading options over stocks when it comes to risk and profit. Now before you comment saying I'm an idiot and completely discredit my channel, let me explain. Let's look at the S&P 500 ETF, aka the SPY. Now at the time of the recording, the SPY took a massive hit, but if we look at the stock, it historically trends upward, usually moving 1 to 3% per day or around $3 to $5 price range. So in this example, let's say SPY is going to now start trending upwards. The current price is $392.85. Let's say we will hold the stock until it hits $400 and our average price per share of the SPY is $393. If we sell one share at $400, our take-home price is $7 in profit. However, our risk was $393. Personally, I'd rather not risk $393 to make $7 in profit. But if I buy a $400 call option that expires in 3 days, that would run me about $28. Assuming the stock move in our favor and the SPY actually hit $400 or above, our option would go actually in the money, turning a $28 position into an over $171 position on the date of expiration. This is equivalent to a 600% return on my investment and already beats the average annual return on a majority of people's investment in the stock market. I risked $28 to make 24 times more money than I would have made trading the actual stock. Just as you saw, this could work really well in our favor. This is clearly a money cheat code, right? Wrong. See, with stocks, you don't lose nearly as much money with options. Options have lots of things that contribute to its price. Greeks and shit, time, volume, implied volatility, and much, much more. If an option doesn't go in the money before expiration, the option will expire worthless, losing practically 100% of your investment. Stocks don't expire, and depending on the stock, it actually won't lose more than 10% of its value, unless there's some major news and there's a major movement in the stock. Needless to say, it's harder to lose more money on a stock rather than losing on an option investment, percentage-wise. But let me make one point very clear. If you're extremely confident a stock will perform exceptionally well over the next few days or even a week, why can't you have the same amount of confidence in an option? Risk a smaller amount to make a proportional amount of money. Now obviously invest at your own discretion. I'm not trying to glorify options over stocks. None of what I say is financial advice. Now if you like the YouTube video and you want to know more about stocks and specifically option trading, I do have a course. The link's in the description below. There's no obligation to join. I do have a free section so you can follow along with one free call out that I play per day, and I hope you guys have a good one.